and welcome to today's Professional Advisor Digital Working Lunch, brought to you courtesy of our partners Schroders and Benchmark. I'm Hope Coumbe, editor of Professional Advisor, and I will be your host for the next hour. Before we get going with today's session, let me quickly run you through the usual housekeeping. So first off, we're going to hear from our guest speakers, and then at the end of the session, we will have some time for questions. Please feel free to ask any and all questions using the chat function on your screens. I should inform you as well that this session is being recorded, and we will send you a link of the recording tomorrow, and do feel free to share that with your colleagues. As usual, today's digital working lunch will qualify for 1 hour of CPD, and we will be sending your proof of attendance along with a copy of the slides and a link to the recording of the session, which will arrive in your inboxes in the next day or two. So let's now get on with the session. From changes in regulation to economic and market conditions, the advisor landscape continues to prove complex. Joining me this afternoon to share the results from the latest Schroders UK Financial Advisor Pulse survey are Gillian Hepburn, Commercial Director at Benchmark, and Olivia Geldenhuys, Investment Director at Schroder Investment Solutions. Gillian and Olivia will cover these results and walk through the key challenges facing financial advisors in 2024 and beyond. And of course, very importantly, to hear an advisor point of view, Colmore Partners Managing Director Richard Meek also joins the group as they discuss the advisor feedback on a range of regulatory changes such as consumer duty, the pensions lifetime allowance, the advice guidance boundary, and sustainable investments. Do feel free to put any questions to Richard using the chat function, which you'll find at the bottom of your screen. And if you wish to remain anonymous, then you can also send me a private message as well. So just before I hand over to our speakers, let me quickly run you through the learning objectives for today. So by the end of this session, you should be able to understand advisor and client views on the investment market in April and May of 2024, how they've changed and future predictions. Explain the cash versus long-term investing debate and whether client sentiment is now changing. And finally, discuss the advisor feedback on a range of regulatory changes, such as consumer duty, lifetime allowance, advice guidance boundary, and sustainable investments. So that is the CPD covered, and I'm going to hand over now to our first speaker, which is Benchmark's Gillian Hepburn. Good afternoon, Gillian.
Good afternoon, Hope, and thank you for having us on another working lunch. We're always delighted to take part and share the Pulse survey results. I'm just going to do a very quick introduction before handing over to Olivia, who will start to talk about the market sentiment and the investment part. Then later on, I'll cover advisor challenges. But I always like to set the survey in context. This is our mid-year Pulse survey. It started about 4 years ago during COVID, when we decided to ask advisors how they were coping, if I could put it that way. Our main survey is in November, and we'll no doubt be back again at that point to talk about that survey. But the interim survey was so successful that we've kept it running now, and today we'll present the findings of that survey. I think it's always important to set the timescale in context. So the survey was conducted between the 25th of April and the 8th of May. So it was just a couple of weeks before the announcement of the general election. And as we come on to some of the slides later on this afternoon, you'll understand why I'm pointing that out. It was completed by 276 advisors from across the UK, and we think this is a highly representative sample of advisor feedback, and I'm sure we can discuss some of that with Richard as we go through the session. So without further ado, Olivia, I'm just going to hand over to you to start to talk about how clients are feeling about their investments, and then we'll break as we go through and have a chat with Richard about whether that's representative.
Great, thanks Gillian, and lovely to be here. I hope everyone is enjoying their lunch so far. I think a good place to start when we think about what this Pulse survey is looking to identify is from an investment perspective, what is the overall sentiment that we're seeing in the marketplace? And for me, working in this field, it really is actually quite pleasing to see a decrease in that bearish sentiment that advisors are actually feeling. And we do now see, obviously there's quite an increase in that bearish, a decrease in the bearish sentiment and an increase in the bullish sentiments, but also that neutral sentiment is playing a part as well. And I think that's really interesting because, we are seeing a lot more market confidence. We are, on the back of really an equity rally. If we remember how, last year really ended with that Sansa rally taking place, and that continued into the rest of this year. So I think that sentiment is often driven by the returns we're actually seeing in the marketplace and how comfortable advisors are actually feeling with that, and certainly the sentiment that they're actually getting from their underlying clients as well. So it is pleasing to see that maybe we are moving into a smoother area. But I think what's useful to look at is then what are some of the other trends that are actually taking place. And so if we look at things that are, factors that the clients are really concerned about, and we've got the advisors to really rank them in specific orders. And the first one that really comes out is around that capital loss being the predominant concern that clients actually have. And I think this makes sense really from a demographic perspective, because if we think about the types of clients that advisors typically have, and again, I'm looking here at averages, so it does sometimes skew the results, but these are typically your clients who are either just pre-retirement or even post-retirement. And so understanding that capital loss is a big concern for them really makes a lot of sense. If we then look at the second greatest concern, which is around inflation, again, we are starting to reach that kind of peak inflation, and we're starting to see those numbers come down. So it makes sense that people are still concerned about this, because ultimately things are still more expensive than they were a year ago, 2 years ago. And that then starts eating into your disposable income actually and how much you're able to spend. So again, if we think about those clients who are in that retirement phase, that makes sense. The other concern is really around generating sufficient income. And I think it makes sense that this is kind of placed in that third position, because it comes with, being concerned about capital loss, especially for those clients who are in drawdown phase. And actually, are they starting to draw into that capital portion versus any of the natural income that's coming out of their portfolios? And then the least concerned item was around rising interest rates. And again, this probably makes sense because we're hopefully at peak interest rates and we're going to start seeing those numbers come down. But again, if the demographics of the advisor base typically is those, close to retirement in and around it, then mortgages are not something that's really affecting those clients. And so I think, again, that makes sense being in the least concern. But what is always interesting to look at across all of these different concerns is how does it actually change over time? And we can actually see there that the greatest concern being capital loss is actually at a lower level than the peak that it reached in November 2022. So again, these factors do actually change, and they can often depend on the market climates. And so some of the things that we are then obviously continuing to look at around interest rates is whether or not those conversations are being had with clients of, do you invest for the long term, or are you wanting to put your money in cash? And again, we're really seeing that kind of sitting at the same level as we've seen over the last couple of pulse surveys, where you've got 90% of advisors are still having that conversation with clients. And I don't think the conversation is going to go away just yet, because we haven't seen the likes of BOE or the Fed start cutting interest rates. And so again, I think there are still attractive levels that are in play. And having those conversations is then what advisors are still going to be exposed to. And so if we then have a look at something that then relates obviously to those cash deposits, is, are clients actually looking to now invest that? And it seems to be a bit of a mixed bag. There are 48% of clients are more likely now to start thinking about investing, but actually 41% are still pretty reluctant to move into that space. And again, I think this ties into sentiment. As we do start seeing a more bullish sentiment, then people tend to feel a little bit more confident. I think what is tough, obviously, for advisors is you don't really want to be buying at the top of the market. So actually, you want to look for those opportunities where there is that volatility, and we can then actually buy at the bottom and then benefit from that growth that we see come off the back of that. And something else that's then obviously quite critical, and this is why Gillian mentions, the fact that the survey was completed before the date of the election, is whether clients are concerned about the impact of a change of government. And naturally, this is something that we are going to be concerned about as an investor base. And a lot of it actually relates to tax, I think, and what policies are going to be put in place depending on which government actually comes into power. And for me, in any case, this is really where advisors add so much value, in being able to have those constructive conversations with clients, making sure that they're in tax efficient vehicles. And it's not just about the investment side of things playing its part, but it's also about the actual financial planning that then needs to happen in that space.
Great, thanks, Olivia. Obviously, loads to cover in that first section. Richard, is this resonating with your clients in terms of, first of all, does it feel like there's a more positive sentiment, and are we starting to see clients who are maybe holding cash invest in the market?
Definitely, without a doubt. I think there's a number of things. One is if they've already got money invested, because of the rally that's occurred of late, then you're presenting to them, a set of returns, historic returns that are in line with expectations and ahead of historic cash returns. So you're kind of demonstrating there was a reason why they invested in the first place. That then gives them the confidence to invest more money. So yes, in short, you're right. Yes.
Yeah, and that piece around the greatest concern for clients is about effectively protecting their capital. Again, is that something you see typically within your client base?
Yes, it is. I think it is, until you've kind of had a proper conversation with them about, there's kind of only one way to make money in the long term, and I'm afraid it doesn't come without risk. So so kind of once they get it, and once you've taken them through a process to get to a level of risk that they're comfortable with, and done all the sensible things like set aside some cash to give them a buffer and so on, then I think that side of things does fall away more. But you've also got to recognise that these people, because of that age profile they're in, they're never going to have any more money again, probably. So whatever they've got today is all they've got. And so understandably, and they can't go back to work and replace it. So understandably, they're going to be worried about keeping hold of it. Sorry, carry on.
Where do you go?
No, that was it. I was just going to say, you've just got to, there's no point trying to say they're sort of wrong in that regard. You just got to let them and help them understand why they would still need to invest some money.
Sure. And I think it's interesting, that slide about the what are clients most concerned about, because probably if we went out to a broad consumer base and not necessarily advised clients, it might be slightly different in terms of the impact of things like interest rates, for example. But I think it does, for me, that slide does demonstrate the typical demographic of advised clients, I think. Yeah. Olivia, I'm going to let you move on to market trends now, and tell us what advisors were thinking.
Great. Well, I mean, I'm sure it comes as no surprise that if we look at what these market trends look like over the next 5 years, this is the expectation that we're trying to gather from advisors, is that the number one thing coming out there is that there is going to be, higher market volatility. And that's really the biggest expectation over the next 5 years. That is then followed by expecting a higher level of bond returns, which is then followed by a higher level of equity returns. And again, I think this makes sense. It really resonates in the investment space. We are still seeing a lot of volatility, especially in a year of so many elections happening. So I think understanding that market volatility and that expectation that it's still going to take place is really useful in setting the scene. And like you said, Richard, it's about, looking at the expectations that clients then have. And if we set the scene that we can expect a lot more volatility, I think that helps to manage those expectations. And then likewise, it makes sense that, we're expecting higher bond returns. We're seeing interest rates at levels that we haven't for quite some time. So you're now actually getting the benefit of a coupon on those bond returns. And then when we do start seeing interest rate cuts, then we can start seeing some of that price appreciation come in. So I definitely think we're going to see bonds actually play a much more active part in portfolios. And obviously, it's important to make sure that clients are in a risk profiled, portfolio that makes sense for their goals. And that's why having, you know, a higher level of equity returns is also something that I think we can expect, especially when there is this volatile environment. You know, it provides a lot of opportunities, certainly for active management to profit on those market volatile, you know, moments. And then we can start seeing some of those higher equity returns come out. Although again, that's not, you know, at a very high level, I think, if we look at those growth expectations. If we then have a look at some of the other almost more thematic type of themes that we could see come out from an expectation perspective, looking at there actually being higher growth overall, that's the biggest expectation, alongside there being lower interest rates. And again, that makes sense. You know, we are starting to reach that cap of interest rates, and now we'll hopefully start seeing some of those cuts come in. So I think it makes sense that we see those two coming out. And then obviously we've got a high expectation that there'll be lower inflation, you know, and that this method of increasing interest rates to try and curb inflation is actually going to work, and we can start seeing those numbers come down. Although again, like I said earlier, it does help to remember that prices are still up from where they were 12 months. It's just going up by less as we move forward. And then onto some of those more thematic side of things. If we look at things like technological advancements, what kind of disruption could that have? And obviously, you know, we've got things like ChatGPT, we've got things like AI really coming out. And I think it makes a lot of sense that we're going to see more disruption in this space. And certainly I know from a personal perspective, how much I utilize things like large language models to, you know, streamline parts of my work. So I can already see that disruption actually taking place in my personal life. And I think we'll start seeing that on a grander scheme as well. And then there's also still the threats of, you know, environmental change. And when thinking about things like climate change in this instance, you know, it's such a difficult one to actually see, but I'm sure especially in the UK here, everyone's already complaining about, is this really summer? So, you know, we are seeing some of the effects of climate change, although it might not feel exactly like that. I think we're still going to see disruption in that space specifically. We can then also have a look at things like geopolitics. And again, no surprise here that this is a big trend that advisors are actually expecting over the next 5 years. I mean, we have half of global GDP going to vote this year, and it really causes uncertainty for people if they don't know which direction we're going to go in. And again, because there are elections happening in so many different countries, we are starting to see some friction come out of different regions. From an investing perspective, though, I would just highlight that, you know, things like geopolitics often get priced into the markets. So, you know, when we're seeing the disruption on screen, it's actually already taken into account from an investment perspective. And it's mainly about the uncertainty where you can start profiting on a short-term basis. But on a long-term basis, we're really thinking about what are the policies that are going to be put in place in certain countries, and how might that ultimately affect investment opportunities. And again, with all of these things, there is both opportunity and risk. So an important one from an investment management perspective to keep an eye on. And then higher deglobalization is also something which still comes up as a trend. Again, we saw this really coming out of COVID, where supply chains were really constrained, and we started seeing, you know, mentions of nearshoring and friendshoring, and actually bringing some of those supply chains closer to home for many countries. And I think we're still going to see that play out. Although it's not necessarily bringing everything back to home country, it's just about spreading it so that your supply chain isn't so heavily constrained in one particular region. If we then have a look at the impact of the cost of living crisis, and again, this comes off of the back of the levels of inflation that we're actually seeing. And Gillian, if I can just ask you, would you remind me, because I think this was a new question that was actually included, was it about 18 months ago into the survey?
Yeah, we included this for the first time 3 years ago as per this slide, because we saw that the cost of living crisis was very much on everybody's radar. And it was quite interesting. When we first launched this question, we asked advisors, do you think that you will be adjusting clients' plans as a result of the cost of living crisis? And it was only about 60%. And then, of course, because we have the benefit of running our own survey, the follow-up question in November, I think, was how many, you know, what proportion have you adjusted? And it was far higher than people anticipated. So yes, this is a relatively new question in the survey, plus the follow-up one that you'll cover.
Yeah, and it's interesting to see this come out, because I wonder, you know, as things start to get a little bit more under control, I guess, and to some extent it actually starts becoming quite normalized, right? And people start adjusting their plans, and then it becomes this new normal. It'll be interesting to see if this number actually drops off. Again, it's the evidence that we're seeing from the survey is kind of there or thereabouts, so we're not really seeing the impact of that just yet. But like you said, Gillian, there is that follow-up question of, what are the reasons that people have actually given for adjusting their plans? And the general consensus really is around those higher household expenses. And I think that's where we see actually a lot of the change coming in, is it's that disposable income, especially I'm thinking for those clients, who've got the impact of increased mortgage payments that they've got to make. I again know of friends who have just had children, and then next thing their mortgages are up for renewal, and that then starts eating into that portion of their disposable income. And you can see there actually the second point there of having an increased mortgage payments is also a reason for people actually changing their plans. Something that I remember talking about at the last session where we went through this, Gillian, was around helping the wider family. And again, it's interesting to see that number has actually come down. So again, maybe it's that stability of, if this client base, the demographics are older, closer to retirement, and they are potentially helping that wider family, young kids or adult children rather, to support their living. It's interesting to see that's started to come down as well.
Yeah, you're right, Olivia. That's come down. Maybe it's because they've already helped them, so they don't need to help any further. I'm not entirely
maybe.
sure.
Well, Richard's nodding, so maybe he's got some personal stories for us as well.
Richard, what is your view on this? The whole kind of, is the cost of living now less on the radar for people as inflation's beginning to come down and people have kind of gone through the worst of it, if I could describe it like that?
Well, I think the initial shock has been dealt with, and why I was nodding is because I think a lot of our type of clients have helped children and who have struggled to cope with that initial shock. And then, of course, because this has been an issue for 2 or 3 years, people have had pay rises, promotions, etc. So it's kind of sort of been absorbed, but I don't think it's gone away, because you've got this continued wave of, as you say, mortgages coming up for renewal. And of course, everyone was hoping mortgage rates would have fallen by now, and they haven't. So the problem is still there. It's just not quite. It's a slow shock now rather than a quick one. And that will continue for a while, I think.
Yeah, a question that we didn't ask on the detail on this survey, but we did in November, was about the number of people that were doing things like stopping pension contributions or reducing them and stopping protection payments, and that was quite worrying, I think, at that point in time. But it's back to something Olivia mentioned on the value of advisors in terms of, I think I did read some statistics about the number of people who were non-advised that were stopping pension contributions. Now, we know that if people need income, then they do need to take it from somewhere, and we can understand that. But clearly one of the benefits of an advisor is to say, if you need to release income, we can work with you on that and look at the best way of doing it, because maybe stopping a pension contribution has quite a dramatic effect over the long term. Is that something, again, Richard, you were having conversations with clients around?
Well, yeah, because once you get out of a habit, it's hard to get back into it again.
Yeah.
And the time that passes, if people were to stop their pension contribution before they get around to doing it again, it can have a seriously detrimental effect on their future.
Yeah. But it's one we'll maybe ask again in the more detailed November survey as to how our clients now behave as things maybe are starting to settle down a bit. But I think, like you say, we're probably over the initial shock of it in terms of some of this, and it's beginning to settle. Olivia, do you want to move on just to the final section for you in terms of sustainability?
Yeah, sure. So I think, sustainability isn't going anywhere, but it is certainly, if we think about the conversations that people are actually having, we wanted to get a sense of, what is the trend that we're seeing in terms of their approach to sustainable solutions, and are clients actually still looking for this as a solution? And I guess it's no surprise really, especially given the tough time that sustainable portfolios have had of late, is that there isn't really any change from the client base. I think, again, when we've got things like wars going on, when we've got elections going on, trying to change the world doesn't necessarily feel like a place of comfort for people when it comes to investing. That's not necessarily the natural progression that people go to think, hey, you know what, the world looks like it's in a bit of a tough spot. Let me invest sustainably. But we probably should be thinking more like that. So no change really in terms of whether clients are looking for sustainable solutions. But if we think about what that impact actually is, and I guess this points to, you know, the reasoning I've been giving as well, is the biggest reason for that impact on appetite is around increased skepticism. And I don't think there is, again, a surprise with that, because as you'll see in a couple of the other questions, there's a lot of things to be quite skeptical about. But obviously some of the other interesting things that come out of that is, you know, pressure on finances. Do people actually want to contribute to sustainable portfolios? And then obviously thinking about things like performance challenges. I think that does, you know, really put it front and center for people, whether they still want to invest in this space specifically. And then another interesting thing is really looking at advisors and their actual confidence in talking to clients about sustainable solutions. And again, with so many different bits of terminology and jargon going around, I think it is a very difficult thing to talk about. And so again, I get surprised that, you know, the level of confidence kind of sits in that middle section. And actually very few people have a very high level of confidence in speaking about sustainable solutions. And again, I just think with so much change in the space, it makes a lot of sense that that's how people how they'd be feeling. And I guess something that really points to that is on the next one around SDR and whether or not people feel prepared. And I think this really says it all. Are you prepared? Literally a 50-50 split between yes and no. And the follow-up question for me here is, you know, if we think about SDR, which labels are actually going to get applied? And I know Gillian added this option as I don't know which label is going to get applied to the portfolios. No surprise that was the option that got the most votes. And I think, again, because there is just so much change in the space and it's not very clear where things are going to go, I think it makes sense that advisors are feeling this way. And certainly from us, from an investment perspective, I think there's a lot that we can take from this as a learning. You know, we've got to make sure that we empower people, because ultimately when we empower advisors to have these conversations with clients, to understand what impact their portfolios are actually having, they are then empowered to have those conversations with clients. And then ultimately clients are empowered to make better decisions, not necessarily from, you know, an investment perspective, but knowing where it is that they're allocating money. And to Richard's point again on expectations, it then really helps to set those expectations so that people actually know what it looks like. I've said it in several client meetings, you know, investing in sustainable solutions is very much a long-term game. We are trying to change the world, and that sometimes comes at a cost. And at the moment, it seems that cost is around sentiment and performance.
Yeah, thanks, Olivia. I mean, that last question was interesting. It was a new one that we put into the survey, and maybe I was a little bit early in terms of asking about which investment label might have the broadest appeal for clients. And when before we launched the survey, we looked at it and said, you know what, I think the majority of advisors, in fairness, probably don't know. And that's because we haven't really, as an industry yet, come out and said which of their funds will be, will fit into the different labels. So I think it's probably slightly early, but it's one that we will definitely track in future surveys and see where are we with this. It kind of feels a little bit, Richard, that sustainability is kind of coming down the radar a bit for certainly for retail clients. We don't see that on the institutional side of our business, but what's your kind of client discussions like at the moment in terms of sustainable investing?
Well, I think you've got a nucleus of clients, relatively small, that are properly bothered about it and want their money to be invested in a sustainable way. And that's not really going to change whether that leads to a good return or not. You've also got the next generation. So we deal with a lot of our clients' children, and they are that won't go away either. But where the volatility has been and the sentiment change has been is where clients perhaps were seeing sustainable investment as a way of making money. And, you know, to Olivia's point, that wasn't really the idea. It might be the idea in the long term, but perhaps a bit of bandwagon and jumping had gone on. And then, of course, as soon as people jump on the bandwagon, they like to jump off it again. And that's perhaps what's seen in the swings of retail investor sentiment.
Yeah, it's a really interesting one in terms of the swing in investment and sentiment on sustainability. And we did wonder when that piece came out around increased cynicism, whether that was as a result of performance or is it actually greenwashing? And what was driving it?
I think there's a bit of both in that, really.
Yeah, it feels like.
Yeah, I think people are obviously and understandably focused on what is they're in retirement and what's going to pay my pension. And then
Sure.
when, as happened with sustainable funds in 22, they had a particularly poor period of returns. People are going, well, what's this all about then?
Yeah. I think you're right. Combination of factors. So again, it will be one to continue to watch for us when we do future surveys and see whether sentiment changes a bit.
Yeah.
So I'm just going to move on to some of the more advisor-focused topics in terms of particularly regulation. So I'm just going to start with consumer duty. And this was a question that we introduced a few surveys ago in terms of what impact did advisors think consumer duty would have on their business. And pre-implementation, so that's back in May 23, predominantly a lot of advisors thought it would have a low impact on their business. If you look at the left-hand side of the chart here in the dark blue bars. And then what we saw was I think a dramatic swing actually to having a positive impact on their business or definitely having a high impact on their business. So if you look on the right hand side, that swung right up in November of 23 to, I think, if I can do my maths, about 41%, and it stayed up there. So what we saw is during the implementation of consumer duty, advisors suddenly realising that they were going to have to spend some time on this, which I think was positive impact was coming from, but also the 4 outcomes, the advisors were going to have to spend some time thinking about how they could evidence those. So we're seeing broadly the same at this point. We also asked in terms of consumer duty as to whether or not this would drive the increased outsourcing of the investment proposition. And this has stayed broadly similar at about 33%. And we're certainly seen that within our solutions business in Schroders, particularly where advisors who were building their own model portfolios suddenly appreciated that consumer duty regulation not only applied to their advice process and their service proposition, but to the production of their model portfolios, where they would have to start producing fair value assessments, target market documents, look at consumer understanding, not just for their own proposition, but for the investment proposition, and everything that we had to do as an investment manager running model portfolio solutions. So we've had, I would say, a significant number of conversations with advisors who are moving away from running their own model portfolios, and that looks like it's continuing. We then asked about the priorities for ongoing implementation of consumer duty within the business, and again, it's stayed the same in terms of the priorities, with ongoing assessments of fair value using client feedback being the number one, followed by consumer understanding. At Benchmark, we've done a lot of work with advisors and with Boring Money, who I'm sure many of you on the call will know. So we did some work with Holly Mackay trying to understand what consumers valued. There was 27 areas of value that consumers identified, and we distilled those down to 5, where we now have a questionnaire that advisors can issue after the annual review to understand whether or not the client has been satisfied. And it's interesting because the pilot's already identified some areas where clients, through the survey, identified that they weren't quite happy with the service. Advisors have followed up, and in one instance it was just purely because they weren't sure if they understood what was going on and what the advisor was telling them. And it was interesting because it had been a long-standing client that up until that point had all seemed very happy. So we're finding that this is of real value to advisors in terms of understanding, how to think about the ongoing assessment of fair value. And the consumer understanding piece is also interesting. One of the things we've tried to do is share experience from the work that we've done in the Schroders group, where we were looking at documentation videos, infographics, how do we communicate with end consumers and make sure that they absolutely understand that. And we've put together hints and tips for advisors to think about. Vulnerable clients for me was interesting because that's certainly on the radar for the FCA. Anybody who is as sad as I am and has read the business plan for this year will see that that pops up a number of times. So again, we're seeing vulnerable clients being an area that advisors are now focusing on, and I'll talk a little bit about that later because we did add in a new question on vulnerability. In terms of the fair value outcome putting pressure on ongoing charging models, we're still seeing 63% of advisors think that that's the case. And I'm always at pains to stress here that this is asking the question about the nature of the ongoing charging model and not about the actual amount that an advisor charges. And this is where I've often talked about what I'm going to call the case for the defence in terms of delivering an ongoing charge and therefore engaging with clients on an ongoing basis. The alternative to that, for me, feels like it's a fixed fee that a client pays when they think they need advice. And if we think about the things that we've covered already on this call, in terms of navigating markets as they change, having cash conversations, thinking about passing on wealth and helping out wider family, is it a gift or is it a loan? Cost of living crisis, sustainability, a whole range of areas where advisors engage with clients, not just at an annual review, but on an ongoing basis, and are usually on the front foot of understanding when they need to engage with clients. And I think for me, this always demonstrates the value of ongoing advice, maybe always one to debate. In terms of vulnerability, this was a new question that we asked. We asked over the last year what percentage of the client base were categorised as being vulnerable. And it was interesting that 63% of advisors, so the majority, said it was somewhere between 0 and 10%. And if you look at recent reports, it's typically, a recent report identified that it typically should sit around 17% of clients being identified as vulnerable. And then there was a further piece of work that was done using the FCA criteria that actually identified that as many as 67% of clients could be vulnerable at any one point in time. So this is interesting in terms of some of the research, but where advisors were identifying vulnerable clients. And perhaps in the next survey, I'm going to split the up to 10% into 0 to 5 and 5 to 10, just to get some more granular information on this. But I just thought it was quite interesting in terms of this whole focus on vulnerable clients and, where are we and should these numbers actually be higher? So, Richard, a few things that I've covered there. Do you want to start with vulnerable clients and what are your views on this one?
Well, I think I'd agree that a significantly higher proportion of clients are potentially vulnerable than any kind of data is, perhaps this survey is intimating. That doesn't mean that they are vulnerable. It just means they potentially are because of the point in time that they're at or things that have happened to them. And, that's not something to be afraid of. It's just, just make sure you've recognised it and that if they need a bit of extra help for a period of time, that's what you do. When you then get down to the people that will be, yes, of a long-term vulnerable nature, it's better to know who they are and to look after them properly than it is to sort of dance around it.
Well, I definitely think that's one for us to watch going forward. I think in November survey, I might ask this again and see if it's changing in any way. And then what about the broader piece on consumer duty, Richard? In terms of the priorities for advisors that they identified in the survey, do these resonate with you in terms of what you're doing in your own business?
Yeah, I mean, you've got to be able to completely demonstrate that what you've said you're going to do for a client is what you are doing for that client and that you are doing it in a rigorous and consistent fashion. And then the other side of it, which we're doing, is this seeking, feedback all the time from clients. So, rather than just relying on us deciding what we think is good for our clients, you're actually getting that feedback from the clients to say, well, actually, what do you value and what do you want? And I don't think either of those things actually are anything to be afraid of. That's all good, isn't it? You know, we do what we say we're going to do, and then we make sure that we're doing everything that we want us to.
Yeah, and again, I think because we started to ask about this, a year past now, it's one that we'll continue to focus on and ask advisors how they're doing. I always talk about this in the context of the assessments of value that we had to do in the asset management business, where the first year that we had to produce the reports, it was a massive learn in terms of, you know, how do we do it, what are the areas to focus on, and then we started to see good practice emerging across the industry and more standardization of the production of value assessments or assessments of value. And I think we're probably going to see more of that, I would think, in the advisor industry in terms of how we go about demonstrating all of this, would be my take on it.
Yeah, well, inevitably when there's new legislation, it takes a while for people to work out what the regulator actually wants to see.
Yeah, and I think as we start to see more examples of what the regulator called good and poor practice, then that's going to help all of us in terms of understanding what the expectations are.
Yeah.
Just moving on quickly to some of the other regulatory items that we asked about. This again was a new question for us, and probably for me this was one of the most interesting responses because it was much higher than I thought it would be. And this was in terms of, would you consider recommending the British ISA if this becomes available? And 80% of advisors said, yes, we would. And it was interesting because up until that point, everything I seem to have read was slightly more negative or challenging. But actually, when I read some of the content, it was often written by providers or platforms saying, actually, this will be difficult to implement, or, you know, how would you transfer an ISA that's got a British element in it? How do we actually monitor it? How do we determine what's in the UK portion? How will this all work? And my view is usually with some of the operational activities, we usually always find a way. But I think it was really encouraging to see the response to this in terms of two things. One is it gives people an increased opportunity to invest in a tax sheltered environment. But secondly, surely it can't be a bad thing to invest, if I could call it, in UK PLC. So I think it was a really interesting result on that one. Advice guidance proposals was another area we asked about, and again a new question. For me, this was probably also higher than I would anticipate in terms of just based on the anecdotal conversations that I've been having with advisors about advice guidance, and was this going to be of any interest to them, and would they think about a new proposition? And at 45%, I was probably higher than I had anticipated. You know, and maybe we can talk about that in the Q&A, but maybe this is the industry starting to think about how can we use regulations such as this to close the advice gap. So I think that was a really interesting one in terms of the responses. And then we also asked about the lifetime allowance. At that point, interesting also, we weren't sure what was going to happen in terms of any regulation. You know, would a future government, back to that question on have I asked my advisor about the impact of a potential change in government? This might have been an area that was of concern for some clients. We asked advisors, did they feel that they'd been given enough help to consider this and to manage any change? And nearly 25% of advisors said, well, not quite, but I think if I can recall, some of the final guidance didn't come out until a couple of days before it was made live. So maybe we just need to think about how we can give as much support as possible. And then in the next slide, we asked about the proportion of clients that have been affected by the change. And 92% of advisors said we have some clients that have been affected by the lifetime allowance. So, clearly it was on the radar for many advisors. And then lastly, the thematic retirement review, again, has the review prompted advisors to think about their retirement income proposition? And it was 33, so a third of advisors said yes, this is something that we've started to think about. And when we asked about which areas, it was the ongoing service proposition. But interestingly, how do we actually assess capacity for loss? What does that look like? And also the investment proposition. You know, we always hear time and again about whether we need a separate investment proposition for accumulation as opposed to decumulation. So I think this is going to be a really interesting one to look at going forward as to our advisors actually starting to put some of these changes in place as they think about the potential impact of the retirement income review. Rich, there's a lot in that little section in terms of, yeah, so apologies. Things like advice, guidance, proposals, do you think that's on your radar?
Well, I think it would be brilliant if it could be on our radar, i.e. if we could be able to provide our advisors, you know, make our advisors available for people to talk to without the regulatory comeback that therefore kind of sort of makes it cost prohibitive at the moment. Well, that would be to the benefit of everyone. And so if there is a way that that can be achieved, yes, please.
Yeah, I mean, I was really pleased, I think, at the response to this one in terms of the advice guidance proposals, because I hadn't heard so much positivity. I know it's still only at 45%, but clearly moving in the right direction. And then what about retirement income? Is that something that's on your radar, Richard, in terms of managing income for clients?
I think it is all about the, I'm slightly less convinced about whether it's the investment strategy or just the planning strategy, i.e. so that they are properly prepared for any volatility that might occur as a result of their investment strategy, and they're properly prepared for all the different bumps in the road that are going to come along during their retirement and need for capital and so on and so forth. So I think having a more in-depth, you know, planning strategy, yes, and it's something we do, that I'm perhaps slightly less convinced about the investment side of it.
Okay, yeah, I mean, certainly back to my comments earlier on the value of ongoing advice. Yeah,
things change. You've got no, you know, you can make the greatest plan in the world, but you've got in reality absolutely no idea what's going to happen. So you've got to be able to react to the changes.
Absolutely. And then just to finish off before I pass back to Hope for some questions is AI. And again, we started to ask this question a few years ago about, did advisors see the development of AI technology, so such as ChatGPT, as an opportunity or a threat to business? And I think this graph says all really. Back in 2023, so a year ago only, it was 57% of advisors saw this as an opportunity, and that's now risen quite significantly to 76%. So I think this is is one that's absolutely all over the radar. I think never is a day go by where we don't see some article about somebody implementing a new form of AI within the business. And I think what's also interesting is the number of different use cases for it. It's definitely something I want to ask more about in the November survey, because if you see from this last slide here, the number of advisors anticipating that they will incorporate AI in some way in their advice process in the next year is now nearly at 20%. That's a lot. That's a lot of advisors that are looking at implementing AI in some way. And I think it's important then for us to think about how can we help, how can we provide support. I was on a conversation just earlier today about should we be helping advisors with an AI policy, for example, in terms of where that data is going, who's holding the underlying data, who's actually running the tech. As we know, there's a significant number of fintechs out there using AI. The financial advice industry feels like it's ripe for use cases for AI. So again, something to watch out for, but certainly very positive sentiment towards AI. So Hope, I'm going to pass on to you now for some Q&A.
Perfect. Thank you so much, Gillian. So actually just picking up straight there on AI, a couple of people have asked about it. Why do you think there have been quite a few changes in the way that advisors view AI? And also for the three of you, do you think that AI is an opportunity ultimately or a threat?
Do you want me to go first? I mean, I think we're seeing it on the radar just because there are more and more companies out there really thinking about how they can help advisors. One of my I guess not a concern. I mean, I still think it's a massive opportunity, absolutely massive. And if it helps us, reduce the cost to serve to clients and serve a broader range of clients, and help close that advice gap, that's got to be a good thing. And that's something that Richard said earlier about advice guidance boundaries. So it's got to be an opportunity, but with that always comes some risks. And I think we've just got to be very mindful about how it's used. I spoke at a recent event about how maybe we're at a Betamax VHS inflection point, but for anybody who's listening to this call that's very young might not know what I'm talking about. But are we still in an early phase in the market? There's a lot of providers out there. How do we pick the right one, and how do we pick the one that's actually going to stay the course? I think is the challenge potentially.
Yeah, I agree. I agree. It's got to be there's got to be positive impact from it. If you can make us more streamlined, make us more efficient, enable us to do more for more clients for the same money, it's got to be a good thing, as long as some of the risks around it, like data protection that you've said, and who's going to end up being the good people and the bad people, get sorted out.
Yeah, my vote has to be opportunity as well. I mean, if you just think small on your day-to-day, how it can create efficiencies where you can then spend time doing the things that really add value. I think that one of the easy examples is minutes for a meeting, right? Is that a productive use of someone's time to take minutes? Probably not, right? Are minutes important? Yes. Being able to go back and refer to decisions that were made is important to have. But using it to enhance on those smaller things, I think it provides loads of opportunities. One of the areas that I think is going to be quite interesting is what kind of regulation comes out with this, because inevitable that there will be some level of regulation. And unfortunately, with all things, and I've seen some of the questions in the chat as well about FCA. So if we're speaking about regulation, ultimately it really has to go down to the lowest common denominator. We've got to think about the most vulnerable person. That's who you have to actually think about when you set things like regulation, which means that people who aren't vulnerable are going to have issues with it because it seems over controlling. But ultimately, we've got to think en masse in those instances. How do we make sure regulation is protecting the most vulnerable of society?
Thanks, Olivia. That actually leads me on quite nicely to a question that someone did have about the FCA, which is, why do you think the regulator is so fixated on costs and competition among firms when there is quite a lot of complexity and diversity in different advisor businesses?
Well, I think they want to see that advice firms are doing what they say they're going to do, and that the clients know how much they're paying for it. I don't think that particularly is a bad thing. I think there's been some historic where clients didn't really know they were necessarily paying for an ongoing service, or where clients weren't receiving it. And, to get rid of that is
it's also the most measurable thing, right? So from the FCA's perspective, how do they put something out, that creates a standard? And by no means am I saying correct or right or wrong. I'm just saying, it's quite difficult to measure things that are intangible. I always speak about, when I speak about value of advice, I speak about the peace of mind that it provides. And I just know this for my wider family who I've put in connection with advisors, so that I have peace of mind that they're being advised. And you can't really put a price on that, but at some level you have to have something where you can compare and contrast from one to the other, because it's so difficult to actually to quantify peace of mind. It's so personal. So I think it's almost dealing with what you have available.
Yeah, I think that's one of the challenges, isn't it? Is that it's quite intangible often, the value, and it's being really clear with clients about where that comes in. It's that whole equilibrium between cost or price and value, and we just got to make sure that we don't just continue to go down the price route, focus on cost, and it becomes a race to the bottom. because, you know, as we know, cheapest is not always best. So it's making sure that we can really articulate the value of advice. And I'm sure, you know, all three of us on this call will have lots of examples of that. But it's making sure that clients really understand why advice is important and what is the benefit to them.
Yeah.
Well, we've got a question here about annuities. Somebody asking, what is your opinion on growing the annuities space, whatever sort of annuity that is, and how annuities are being used to build and underpin essential income needs to complement an investment strategy for a blended approach that can really cater to longer term needs for clients?
Well, so we are doing that. We are adding, you know, for clients, not necessarily buying an annuity with all of someone's pension funds, but with part of it to give someone a basic level of guaranteed income in combination with their state pension, and then just draw down part as an excess and their investments as an excess fund over that. Well, that's got to be something to consider, because at, you know, rates of 7 or 8% as someone's getting towards their 70, that's a good investment. So yes, this is what I would say.
Yeah, I think Richard's right. There's always a place for annuity, isn't it? And it's down to clients' individual circumstances as to, you know, what that looks like, when it might kick in or when it might be appropriate. But I think increasingly now advisors are using that, and, you know, we all know why annuity sales dipped massively and has changed. But I think there is absolutely a place for annuity in financial planning.
Getting away from the idea that it's a binary decision as well.
I was going to say the same.
You either have an annuity or you don't. It's like, no, that's not really it. It's part of the plan could be an annuity.
Correct. Yeah, and I would completely agree with that, because it felt, you know, when I was working on annuities many years ago now, it felt like that was the option. It was binary. It was annuity or not. Whereas I think it's a blended kind of solution now, in terms of what is the right thing for the client at different stages of that post-retirement journey as well.
Yeah.
Well, to wrap things up, I just wanted to ask the three of you what you found to be the biggest surprise in this most recent iteration of the survey, and was that a positive or a negative surprise? Perhaps if we can start with you, Gillian.
Yeah. For me, something that I've already mentioned, it was definitely the response to the British ISA, I would say, and that's particularly because everything that I'd read up until that point was, I'm not going to use the word negative, it was a lot more challenging around, you know, about the whole concept. And for me, when I got that number through, it was one of the, I always talk about this survey in terms of, there's some things that I could have probably guessed. It's just nice to have a number and know that I was, you know, I've clearly got my finger on the pulse of the market, hence the pulse survey. So it's reassuring. That was one where it was like an aha moment. It was not, if I'd been asked to put, I'm not a gambling person, if I'd been asked to put money on what I would have thought, it would have been a lot lower. So that was and I think it's a really positive response. So it's a good result.
I think personally, I would say there wasn't many surprises. It was more reassuring, actually. You know, we're all running businesses and you kind of run it in isolation. Yes, you read the, obviously, professional publications and so on, but it's nice to know that kind of a lot of people are thinking the same way that you are at any given time, because there's not much access to that information.
Yeah, I'm going to echo you, Richard. It's that reassurance, and the one thing I'm quite grateful to see is around sentiments. It's been, I mean, and I'm speaking to advisors only, so I can only imagine the kinds of conversations that advisors have had to have with their end clients. But when you have to constantly have negative conversations, when you constantly have to set the expectations that, you know, things are volatile and it's bad, but maybe it's not that bad, you know, that's just, the eternal optimist in me doesn't resonate with that. So I'm quite glad to see the improvements on sentiments, even if it is to a more neutral sentiment away from that bearish sentiment. I'm quite happy to see that, and maybe we can manifest some positivity for the rest of this year.
Yeah.
Fantastic. Well, I'm afraid that is all we have time for our Q&A session. So thank you very much to Gillian, Olivia and Richard for joining me, and to all of you at home for tuning in as well and sharing your thoughts with our speakers. Now, our final online event before we break for the summer is going to be next week, the 26th of June, and that will be a digital working lunch event, once again, this time with Baillie Gifford, where we will be joined by Seb Petit, who is the Investment Specialist Director for the Baillie Gifford Responsible Global Equity Income Fund. Then after summer, we are going to be back on the road again with a really busy schedule of events from September, starting off with our ever popular multi-asset roadshow, which kicks off in Harrogate on the 11th. On the 12th of September, we'll then be in Warrington, and then in Cardiff, Bristol and London the following week. At that event, you're going to see presentations from BlackRock, Downing, HSBC Management, Quilter Cheviot and Quilter Investors, and our keynote speaker for that series will be De Facto's Head of Insight and Consulting, Paul Tinkler. Then on the 25th and 26th of September, we're north of the border with our regular Scotland Investment Roadshow in Edinburgh and Glasgow. Here you'll see presentations from 6 different groups: Bordier, Downing, Evelyn Partners, Orbis, Quilter and Simply Beers. And making sense of all of that will be our keynote speaker, Square Miles Strategic Relations Director, Jock Glover. Then the last one to tell you about for today is on the 1st of October, we're going to be back in Warrington for the annual PA360 North Conference, where you will hear over 20 different industry experts together and have the chance to meet all of our sponsors in the exhibition area of the conference. So do put that in your diaries and come along to network with your peers at what is now the largest business management conference for advisors in the north of England. So all in all, that's about 12 hours of CPD that is upcoming for you. And as ever, if you wish to find more information on that or sign up to any of our events, you can do that at professionaladvisor.com/events. So that is it for today's session. I trust that you found the last hour helpful and worthwhile. And if you have, perhaps we'll see you again very soon. Goodbye.
Thanks.